Assalamualaikum warahmatullahi wabarakatuh. Hello, let me introduce myself. My name is Rara Zajeng Pratiwi from the accounting class 23A with NPM 234120008. In the course of Financial Markets and Institutions with the lecturer Miss Renisa Helena Putri, SE, M.Si, I will explain about bank health. Definition of bank health. Bank health is a condition that describes a bank's ability to operate effectively and efficiently, as well as meet its obligations to shareholders, customers, and regulators. The assessment of bank health aims to ensure that the bank operates in accordance with the standards set by regulatory authorities and in a state that can maintain financial stability. Next is external factors affecting bank health. Regulation and monetary policy. Interest rate policies from the central bank and regulations set by banking authorities have a significant impact on the health of banks. For example, tightening interest rates can increase the cost of funds for banks. Macroeconomic conditions. Economic growth, inflation, and unemployment rates will affect credit performance, as well as the ability of customers to meet their credit obligations. Competition in the banking sector. Competition among banks in gathering funds and distributing credit can affect the bank's profit margins and the bank's ability to attract customers. Next again is Bank Health Assessment System. 1. Asset quality, qualitas asset. Asset quality refers to the level of risk of the assets held by the bank, particularly the loans disbursed. Non-performing loan, NPL, one of the important indicators for assessing the quality of a bank's assets. NPL is a problematic loan, which means a loan that is not performing or has been overdue for more than 90 days. Having the objective of assessing how well the bank manages credit risk and the potential losses from its credit portfolio. 2. Capital adequacy, kikukupan modal. Capital adequacy is the bank's ability to withstand potential loss risks arising from its assets. The capital adequacy ratio, CAR, is the ratio of the bank's capital to risk-weighted assets. Regulators require banks to maintain a CAR of at least 8% of total risk-weighted assets, having the goal of ensuring that the bank has sufficient capital to face unexpected risks. 3. Management. This aspect assesses the competence, strategy, and effectiveness of management in running the bank's operations. Management indicators, leadership, experience, integrity, risk management, and corporate governance, good corporate governance/GCG. Having the goal of measuring management's ability to lead and manage the bank's operations effectively and mitigate risks. Next is financial statements as a tool for assessing bank health. 1. Balance sheet. Assets shows the total assets owned by the bank, both in the form of current assets, cash, credit, and fixed assets, property, equipment. Liabilities shows the total obligations of the bank, including third-party funds. Deposito, tabungan. Equity, it is the own capital that reflects the net worth of the shareholders in the bank. 2. Income statement. Operational income includes interest income from disbursed loans, as well as non-interest income such as commissions or fees from banking services. Operational expenses, including interest costs, employees' salaries, and other operational expenses. Net profit, income after deducting operating expenses, which is the main indicator of a bank's profitability. And the last is financial statements as a tool for assessing bank health. 3. Cash flow statement. Operating cash flow measures the amount of cash generated from the bank's operational activities, such as credit disbursement and deposits received. Investment cash flow measures the outflows and inflows from the bank's investments, such as the purchase of fixed assets or investments in financial markets. Financing cash flow measures the changes in cash due to financing activities, such as bond issuance or dividends paid to shareholders.